Hey guys, Brian Asset Management here, and today I'm looking at PayPal, ticker symbol PYPL, using my 7 simple steps. Stick around to the end of the video where I give my valuations of PayPal based on discounted free cash flow and the Buffett-Graham intrinsic value. Now let's quickly have a look at the share price over the last 2 years. You can see it was trading between $100 and $110 a share, hit $89 at the bottom of the pandemic. What a great time that would have been to buy, and then has absolutely skyrocketed since then, eventually hitting its all-time high at around about $298 a share, but is now at $244 a share. Just before I get on to my 7 steps, I want to say, guys, please leave a like if you enjoy the video. The more likes you give me, the more it helps me out, and in return I'll give you more quality stocks and my analysis as soon as I possibly can. So now let's get on to step 1, is the PE ratio less than the market. PayPal's current PE ratio is a very high 69 and the market is 21.5, so that is a fail. The next step is the PE ratio less than the sector, once again 69.5, but the sector is technology, which is 40.5, so that's 2 fails off the bounce. But if we go into financials, it's going to be getting a lot better for PayPal. So first is the revenue increasing, and the revenue has gone from 13 billion to just over 18 billion, so that's a pass. Next is the profit increasing, and the profit has gone from just under 1.8 billion to just under 1.9 billion, so that's a pass again. Profit has increased. Next we want to see are the shares outstanding decreasing, and the reason for this is if there are 10 shares of PayPal and I own 1, then I own 10%, and if PayPal buy back 5 more of their shares, there are only 5 shares outstanding, then I would own 20% of the company. So it's a good move if they're buying back their shares, and PayPal has. It's gone from 1.2 billion to just under 1.2 billion. So they haven't bought back many shares, but they are buying back shares, which is good news. Now we want to look at the balance sheet here to see if the current assets are greater than the current liabilities, and the current assets of PayPal are a whopping 51 billion, whereas the current liabilities are only 39 billion, so that's a pass there. And actually, if I look at the total liabilities, they can pay off their total liabilities with their current assets, so I'm giving them an extra check mark there. That's 2 check marks, 1 for current assets greater than current liabilities and 1 for current assets greater than total liabilities. So our final step is the free cash flow increasing, and the free cash flow has gone from 1.8 billion to 4.3 billion. So that is a pass there. Their free cash flow has increased massively over these last few years. PayPal does not pay dividends, so I won't be going through that. So I'm going to look at some of the analyst ratings. And as you can imagine, analysts are very bullish on the stock. Strong buy from 35 analysts, 31 buying, 4 holding, 0 selling. It has a price target of $307 a share, which is a 26% upside, up from $244, and on the high side has $375, which is massive. That's about a 50% increase. So analysts are very bullish on this. And heading over to Simply Wall Street, and I would have guessed what these guys would have said because they use a discounted free cash flow. They actually have it at fair value at $189 a share, which means it's currently overvalued. It fails their analyst checks, and this is probably because their PE ratio is very, very high. So Simply Wall Street saying it's not a buy based on their model. So just before we head into my valuations, I want to give a quick summary. PayPal with a market cap of 286 billion and a current share price of $244, and these are the 7 steps. Was the PE ratio less than the market? It was not, with 69 to 21, so that's a fail. PE ratio was also not less than the sector, 69 to 40, but then went on a bit of a tear. Revenues increasing from 13 billion to 16, profits increasing from 1.7 to 1.8, shares outstanding are decreasing from 1.2 to 1.17, so passes off the bat. Then current assets can pay off current liabilities and total liabilities, with 50 billion to 38 and 50 billion, so 2 passes there. And finally is the free cash flow increasing, yes again, and it has gone from 1.8 billion to 4.3 billion, so that is 6 passes out of 7 steps. I gave an extra step here because the current assets were greater than the total liabilities, so that's 6 out of a possible 8. Now we want to look at some ratios. The free cash flow has an average of 3.9 billion, so I'm going to look at their most recent cash flow, as I believe that's a more true number. So that gives a free cash flow yield of 1.54% and a free cash flow ratio of 64.9. So these ratios are pretty high, but in a company this fast growing, these are things to be expected in the current market. So do you believe in PayPal? These numbers, I would like to see this are between 3 and 5%, and this anywhere between 20 and 40, but this is a very fast growing company. And finally, I'm going to look at my discounted free cash flow model and my Buffer-Graham intrinsic value, and I've calculated the future free cash flows, and these are pretty bullish estimates as well, as a lot of analysts are bullish on PayPal, and that gives a calculated stock price of actually $146 a share. So discounted free cash flow does not care for this model because PayPal is a fast growing growth stock. If we go to the Buffer-Graham intrinsic value, based on the earnings per share, based on this massive expected growth rate, they have it at a fair price of just under $290 a share and a Graham price of $217. So this is a very reserved price, which means if you wanted to buy the stock and hold it for 20 years, this is the number you're going for, but they have a fair value of $290, so undervalued according to this model. This model says it's a buy, free cash flow says not, but with these growth stocks that have gone up massively, it normally looks at the free cash flow, whereas this looks at the future growth. So according to this model here, it is a buy. And finally, just going to look at the technicals here of PayPal. I have the price over the last year, and I have a 50-day moving average in green and a 200-day in gold. So if you see that in May, the 50-day moving average crossed the 200-day, which is a massive buy signal, and you can see by the volume here, you would have bought in May and held the entire way through. So the price has broke through the 50-day and has acted at a bit of a resistance here. It hasn't broke below it too often, and when it has, it's fired back through. As you can see here, it didn't break it again, and it has crossed through here in March, but it looks like it is coming back through. So these lines are diverging. The price is being consistently above the 50-day moving average, and it is hopefully going to burst back through here. So according to technicals, if you based it on golden crosses alone, you would have bought it in March and had a good time, but according to the more recent numbers, it is looking like a buy also. Right guys, I just want to thank you all for watching again. Please leave a like if you enjoyed the video. Give a comment on your thoughts on PayPal and what stock you want to review next. Did you enjoy my breakdown of the steps here? I'm going to continue adding this, and I just want to say thank you all for watching, and I'll catch you guys next time.